And again, we want to thank you for being on the call today with Monica Rebella CPA and President of Rebella Accountancy, which is a CPA firm that specializes in accounting, tax, and consulting services for hundreds of dentists and business owners in California. The topic of our call today is maximizing your Social Security benefits with Kate Gregory. If you're not a current client of Rebella Accountancy or you have not met her, Monica Rebella is a CPA and has 27 years of accounting and tax experience, which includes 13 years working with the Big Four, Big Eight firms, and over 14 years experience working with dental practices. She is the past president of the Orange County, Long Beach chapter of the California Society of CPAs and is a member of the AICPA. She has conducted training sessions for accounting firms as well as lectured on tax and business matters to the California Society of CPAs, UCLA Dental School, and the Orange County Dental Academy. She runs her own firm in Tustin, California, providing accounting, tax, and consulting services for over 300 businesses throughout California, specializing in dental offices and small businesses. Monica, welcome to the call.
Thank you, Jeff, and thanks to everybody on the line. We're really excited this evening. We have talked about Social Security and maximizing it before, but we have Kate Gregory with us this evening, who actually specializes in this in addition to wealth planning and wealth management with clients. Kate is a certified financial planner with Gregory Advisors in Orange County. I've known Kate and Ted Gregory for 10 years, and they work with several of my clients and do a great job. Kate's got her specialized license of certified financial planner out of the College of Financial Planning in Denver. She works with implementation of financial plans with her clients, but they also go further. They actually do work with individuals that want to invest in real estate and do 1031 exchanges, which most financial planners will not attempt. In addition, they help parents that are late to getting in on college funding as well as Social Security benefits, which of course is later in our careers. So Kate, we're so happy to have you on the call. Welcome.
Well, welcome to you, Monica, and thanks for having me speak this evening. So this evening we're going to talk about savvy Social Security planning, and we're focusing on what baby boomers especially need to know to maximize their retirement income. Because for most of us, when our parents retired, they probably didn't think too much about Social Security. They just went down to their local office as soon as they turned 65 or 62 if they retired early and applied for benefits. They took their benefits for granted and they didn't ask very many questions. But as with everything else with the baby boomers, we're approaching the Social Security question in a very different way. So if we could advance to the next slide, please. So let's see. So if we could go back one, there's a slide. There we go. So what do baby boomers want to know? Well, first thing we want to know for certain is Social Security going to be there for us? We've been told for years that the system's going broke, but now that it's our turn, is that really true? We also want to know how much we can expect to receive. Before you retire, you've got to know how you're going to support yourself, and that means doing a budget, lining up all of your income sources, and knowing how much you can expect to receive from each. Social Security, because it's a relatively known quantity, represents the foundation of that plan. You're also probably asking, when should you apply? You may have heard that if you apply early, your benefit will be lower than if you apply later. But is it really worth missing out on all those extra checks to have a higher benefit later on? We're going to talk about that a little bit later on this evening. And something your parents probably never asked is it possible to maximize benefit? And there's absolutely nothing wrong with using the Social Security rules to your advantage. This evening, we're going to talk about 5 ways you can maximize your Social Security benefits simply by knowing the rules and making smart decisions. Finally, you're probably wondering if Social Security will be enough to live on in retirement, and you probably already know the answer to this one. Social Security represents about 40% of the average retiree's total income, but by coordinating it with the rest of your retirement income plan, you can pursue the universal dream of a comfortable retirement. So if we could move to the next slide, please. So most people tend to minimize the value of Social Security. If they understand it, they're likely to think that they're going to get something back from the system, but they really think it's a minimal amount and it's not really enough to count on. But Social Security is actually a lot more valuable than most people realize. So we could go to the next slide. The reason why is Social Security offers income that you can't outlive. It's one of the few sources unless you have a pension. So if you're worried about running out of your personal assets in old age, you don't have to fear that with Social Security because it continues until you die. And, of course, the longer you live, the more you will extract from the system. So let's say, as per the chart, your benefit starts out at $2,000 per month, and you live 10 more years. Over your lifetime, that means you would receive over $300,000 in lifetime benefits. And you can see what happens if you live 20 more years or 30 more years. It's quite a sum of money. This also includes cost of living adjustments of 2.7%, which Social Security has a cost of living adjustment every year. And I have a chart from 1977, and the only 2 years where there was a zero cost of living increase was 2010 and 2011, just as a point of interest. So we can go to the next slide. So a little bit more on the cost of living adjustments. This is another chart that shows what happens with these cost of living adjustments. So, for example, if your benefit starts out at $2,000 per month and the cost of living adjustment is 2.7%, in 10 years you're actually going to be getting $2,611 a month, and in 20 years you'll be getting $3,408, and you can see from 30 years the sum that you would get. So, but there's really no way of knowing exactly what they'll be, but 2.7% seems to be a reasonable estimate. That's what the Social Security trustees use to project costs and benefits under their intermediate cost scenario. So if we could go to the next slide. So the first question, will Social Security be there for you? A lot of people are worried that Social Security won't be around when they go to retire. This has led to a lot of misunderstandings and irrational fears about the solvency of the Social Security system. We're going to look next at what the Social Security trustees say. Every year they publish a comprehensive report showing the long-range outlook for Social Security. So you could advance to the next slide. So this is the trust fund balance as of 12/31/2014. You can see it's a sizable amount of money, thank goodness. Social Security, as you probably realize, is a pay-as-you-go system. Payroll taxes from current workers go into a trust fund, and they're immediately paid out to current workers. And because baby boomers have been in their peak earning years, the trust fund has accumulated more than needed for the current benefits. So right now, as you can see, the trust fund holds $2.7 trillion, and this money is invested in special issue treasury securities. Now, as baby boomers start retiring, obviously, these trust funds are going to gradually be drawn down. The next slide.
Kate, can I ask a question before we go on?
Sure. Yeah, absolutely.
So if we look at this slide, it actually tells us that we've got more assets sitting there than we actually spent. So in other words, we didn't have to spend everything. So when they say it's a pay-as-you-go system, actually we build up some money some years.
We do. Absolutely do. Yep, and that's right. We absolutely do. And, you know, it's interesting because I'm trying to be optimistic that we have a lot. The Gen X generation is a large group. It's even larger than the baby boomers. So let's hope that they all get jobs and make a lot of money so they can continue to pay into this trust fund. Anyway.
Great.
Yeah, very good. So the long-term projections for Social Security. So actually, over 75 years, the cost will begin to exceed income. So there's enough reserves that the system will be 100% of promised benefits until 2033. And after that, if things continue as they are and this actually occurs, then something will need to be done to reform the system. So we go to, there we go. So we're going to talk a little bit about what some of the ideas are floating around for reforming the Social Security system. One of them is to increase the maximum earnings subject to Social Security tax. I believe that goes up anyway every year, but in 2015 it's $118,500, and earnings are subjected to the 6.2% paid by the employer and employee. Another reform calls for raising normal retirement age as life expectancies increase. Currently, full retirement age is 66 for people born between 1943 and 1954, and 67 for people born in 1960 or later. Still, another reform proposal would be to change the benefit formula so that future increases would happen at a slower pace, and this would affect the benefits of future retirees. And some are talking about changing the formula for cost of living adjustments. This could give retirees smaller benefit increases going forward, although the changes are expected to be minimal. You can actually learn more about Social Security reform proposals from the American Academy of Actuaries at their website, which is actuary.org. But the bottom line for baby boomers is that your benefits are probably not likely to be affected by much, if anything at all. So it's our opinion you can stop worrying that Social Security won't be there for you.
I find it interesting in some of these things to restore the system to solvency have nothing to do with some of the things we're going to talk about using their rules to maximize benefits.
That's right.
So
I do too.
I guess they haven't realized that there's more money being given out that maybe we shouldn't be giving out. So
I have had that thought many times. I've often thought, I wish they'd quit talking about this in the press because somebody's going to get a hold of this idea, and then I agree with you completely. And the thing is a lot of the things we're going to talk about later, they were actually put in place in 2000 with the Freedom to Work Act. So they're pretty recent. You know, I think they wanted to encourage people to continue working, and so that's why they made all these things, these different changes that we're going to discuss a little bit later on. But good points, Monica.
All right, well, let's go.
Okay, so the second question that you probably have is, how much can you expect to receive? Okay. So your benefit depends on two things. It depends on how much you earned over your working career and the age at which you apply for benefits. We can advance to the next slide. Okay. Now this is where it gets a little bit complex and a little bit dull, and actually you really don't need to understand this formula, but we're going to explain it to you because some people find it interesting. So what Social Security does, if they look at your annual earnings over your lifetime, index them for inflation, and pick the 35 highest year's earnings to include in the formula. The indexed earnings are totaled and divided by 35 to come up with an average. Now, here's the thing. If you don't have 35 years of earnings, you've got some 0 years, and this can have an effect of lowering your Social Security benefits. And this happens with a lot of women who leave the workforce, but women can be eligible for spousal benefits as well as men, which we will cover a little bit later. So then next, a formula is applied to the averaged indexed monthly earnings to determine your primary insurance amount, or what we are going to call PIA. This is the amount you'll receive when you reach full retirement age, and as mentioned earlier, if you were born between 1943 and 1954, your full retirement age is 66. Each year, the cost of living adjustments are applied to your benefit to help you keep up with the cost of living.
So
let's go to, yes.
Let's talk about this a little bit, because I hear this all the time from people. They take my last 5 to 10 years of working income, right? That's what they take. And you pointed out here it's 35 of earnings. And I've heard it's actually could go all the way back to the time that you ever started. And they bring it to current dollars. So it's not if you made $100 a month that it's going to stay at $100 a month when you first started working. They actually bring the value all to today's dollars in order to do that every year and give you what your new year's Social Security amount will be annual biannual. But like you commented on, the highest 35 years, they really do take 35 years. So if you have 0 income years, that's in their calculation.
That's right. So if you have 35 years of work and some of it is zeros, that is in their calculation. So one of the things that we mentioned later is if you should really look at your Social Security record and make sure that it's accurate, especially if you're self-employed, because if you're self-employed, then that's being reported from your tax return versus if you are an employer-employee where that's coming in through a payroll, situation. And so if you do have zeros on your work record, you might think about working a few more years, paying into the system to make up for it, depending on how many 0 years you have, obviously. Anyway. Yep.
Okay.
All right. So this is an example of a baby boomer. He was born in 1953, and he earned the Social Security maximum every year since the age of 22. And again, you don't need to know how to do this, but we're including this because some people do find it interesting. So basically, his average index monthly earnings work out to be $9,066. His primary insurance amount is calculated. The first 826 is multiplied by 90%. The amount between 826 and 4980 or 4154 would be multiplied by 32%, and the amount over 4980 or 4086 would be multiplied by 15%. These amounts are totaled and rounded up to the nearest dime to come up with 2685, and this is the amount the worker would receive at full retirement age. It's complicated, but fortunately, you don't have to figure this out for yourself. Thankfully, right? Okay. So full retirement age is a really critical thing to understand, especially when we get further into the presentation and we're talking about benefits. And you can see what the full retirement age schedule is from this slide. And it's the age at which you can claim full unreduced benefits. So basically between 1943 and 54, it's 66, and between 55 and 59, it's 66 and some months, and then 1967 or later, 1960 or later, it's age 67. So.
Can I ask you a question, Kate?
Absolutely.
This comes up, and I don't recall that we have it in here, so I thought I'd ask it here. There are rules about taking Social Security in the year you reach full retirement age as to how much you're going to get that year you reach full retirement age. Would you, because I kind of understand it, but why don't you explain? Because there definitely is, you can actually get a lot less than you think in that year you turn full retirement age because of how much you have made working.
Right. Exactly. Yes, what it is if you collect before full retirement age, they'll withhold $1 for every $2 you earn over $15,000 if it's at age 62. If it's at age, let me see, because I do have a little information on that. But if it's during your year that you attain full retirement age, it's $1 for every $3 over $41,000. So what happens is, and this is a really confusing thing for everyone, is they basically hold the money back for those months or years that that you start collecting. So let's say you started at 62 and you made too much money. They hold that money back, and then when you get to full retirement age, they give that to you. I don't recommend doing that strategy just because, I'm going to get it back anyway, because you're giving up some other things that you get if you wait till full retirement age, but that's how it works. You don't lose it. It does come back to you.
What do they recalculate once you're full retirement age? What the 30% discount you got on taking it early?
Yes,
so they completely recalculate it. Okay.
Yeah, they do. But again, there's so many benefits, especially if you're married, if you can manage to get to full retirement age, that I really wouldn't encourage it unless, as we discuss later, you really need the income. And in that case, for whatever reason, you will want to take it. But anyway, very good question.
So if you're taking it at 62 and you're still working, and so you make more than the $15,000 a year you're allowed to make, so you can have even though it's reduced, have your full benefit when you're 62 or before full retirement, that is the key. That's the key that they will throw back in on your full retirement, but because you went over the $15,000. But if you just take it early, there is no recalculation.
Right. If you take it early and you make too much money, then they hold it back, and you'll get it at full retirement age. And it is recalculated. I don't know how they do the formula, but it is a return to you. But it is very confusing because I don't know, probably because we don't understand exactly how they're going to calculate it, and that's sort of the other factor, Yep. So, got it. All right. So, what happens if you apply for early benefits at various full retirement ages? So you can see from this chart, if you apply at age 62 and your full retirement age is 66, you're going to get 75% of your benefits. And if you apply at 62 and your full retirement age is 67, you get 70% of your benefits, et cetera. So these amounts can actually be prorated monthly. So you can apply any time after age 62, and your benefit will be reduced by that particular amount. The only thing is this never comes back. So you start out at 75% if you apply at 62 and your full retirement age is 66, and it stays at that 75% level for the rest of the time that you're collecting Social Security. So that's the problem with applying early. You give up possible future greater amounts of money. But again, it's a decision on what's best for the person as well. So if you go to the next slide. Now, on the converse end, if you apply after full retirement age, you earn delayed credits of 8% for each year you delay. So if your full retirement age is 67 or 66 and you apply at 67, your benefits will be 108%. At 68, it's 116%, and so on. So that's why it's really great if you can wait, because not only will your benefit increase due to cost of living, but you will also get these 8% annual delayed credits. So if we could go to the next slide. Okay. So how do you estimate your Social Security benefits? Because you probably don't want to go through that calculation that I did a few slides back. One thing I would suggest that you definitely do is go get your Social Security statement online. I don't think they're sending them out anymore anyway. So you can go to the website listed on the slide, which is socialsecurity.gov/mystatement. And I suggest you go on there and register your account anyway, because you're going to be registering your account and your Social Security number, and you don't want to have a situation where somebody else goes on and registers it, meaning identity theft. So I highly, highly suggest you go on, get your statement. You can actually even have them send you text alerts if somebody were to go on and try to look at your Social Security statement, which is really kind of interesting. As well, on the Social Security website, they have calculators. They have a retirement estimator that will actually go into your specific earnings history after you enter your personal identifying information, and the site is secure, so you shouldn't be concerned about that. These particular calculators do not factor in the cost of living adjustments that we've been talking about, so it means the actual benefit's going to come out lower than what you would have if you use the cost of living adjustments. We have calculators that include those, however. And also there were some other calculators on the Social Security website that you can see on the slide. And I know, Monica, you and I discussed this, and we agreed that you have to have to really know what you're looking for when you get on there, right?
Not only do you have to know what you're looking for on there, is that you have to be pretty savvy about the types of questions they ask you. As I have had people go on site, they don't want to go to Social Security, they don't want to call, so they go to the website to sign up for their benefits. And it can be confusing on what they're asking you, because we're going to talk about some strategies that Social Security is not necessarily going to tell you about. And so you have to be very specific about what you're asking and what you're signing up for. So I would just say go, look at it, kind of get comfortable with it. You can ask questions of Kate. She's going to provide her information, or me. But go and do it, because there is a lot of really good information. And like Kate said, protect yourself. Go and set up your account so no one else somehow can get in there and do that. And just get comfortable with it. Once you start answering questions, you don't have to continue. You can just exit out. So if you get in there and you get really confused about what they're asking, call, because then we can talk through it. Because they will allow you to sign up there, but you may not be signing up for what you thought you were.
Right, and we'd hate to get yourself in that position where you have to undo something that you didn't mean to have happen. So, yeah, very good advice. So Social Security provides spousal benefits, primarily because when it was instituted, most married women didn't work, and so they thought, well, we want to give women a measure of financial security in their old age, so we will provide spousal benefits. And the spousal benefit is 50% of the worker's primary insurance amount if she applies for it, again, at her full retirement age. So in this example, we have John, whose primary insurance amount is $2,000, and Jane's is $800. If she applies for Social Security at her full retirement age, she will get 50% of John's primary insurance amount, for $1,000, and this is $200 a month more than what's based on her own record. And right now we're talking about spousal benefits in a traditional sense. Then we're going to show you some innovative ways that you can take advantage of spousal benefits. So let's go to the...
Before we go to the spousal, move on from this.
Sure.
So she would normally get $800, but if she applies for spousal benefits, she could get $1,000. Does that change if John starts taking his retirement benefits, or is she always entitled to get 50% of his, and it never goes back to her $800?
Okay, so what has to happen for this first is John has to file for his benefit before she can get the spousal benefit. So if he doesn't file, then she can't do that. And she could collect at a younger age. It would just be, and we'll discuss it a little bit later, just be a percentage, a lower percentage of that amount. So John can absolutely apply. They can both apply. If he's 66, he's full retirement age, he goes in and applies, he collects his benefit, and then she can go in and collect her spousal benefit at that time. Yeah.
And so there is no time that she would go back to her $800. She would always be able to get the $1,000, 50% of his?
I think, yeah, she would never go back to her $800. I know there is, excuse me, let's say she has a higher benefit than him. Mm-hmm. This is where it gets really tricky, but she could apply for her benefit at age 62. And then when he applies at full retirement age, and she's at full retirement age, that's the key factor there, she could say, okay, I'm going to suspend mine, and I'm going to go back on his, and then at 70, I'm going to go back to mine.
Okay.
But you have to be careful, because if she ends up getting on spousal at 62 instead of her own, then I don't know that can happen. Does that make sense? That's why it's very, very tricky, and you have, like you were saying before, you have to tread cautiously through this, which is not what most of us think, I guess. So, okay. So the rules for spousal benefits are that the primary worker, in other words, the one who the spouse is collecting on, must have filed. Now, that person can delay their benefit until 70 in order to receive a higher amount, and then file for his benefits, and basically just file and ask that they're suspended. And we're going to talk a little bit more about that in a minute. The low-earning spouse must be at least 62 for a reduced benefit or 66 for the full spousal benefit. Spousal benefits don't earn delayed credits after age 66, so it doesn't pay to wait. In this previous situation, you're better off starting because you're not going to get the extra 8%. There are probably a lot of questions about spousal benefits, and we're going to talk about this a little later, but next we'll talk about divorced spouse benefits. Okay. So divorced spouse benefits are very interesting simply because, for example, a woman can receive Social Security based on her ex-husband's work record, providing the marriage lasted 10 years and she's currently unmarried, and vice versa. Men can also receive divorced spouse benefits, too. So if the divorce occurred more than 2 years ago, the ex-spouse doesn't need to have filed for his benefit. However, he must be at least 62, which that's even more interesting. Seems like ex-spouses
get benefits easier,
more than
and quicker.
Yep. Okay, so let's see. So here are more rules regarding divorced spouse benefits. More than one spouse can actually receive benefits on the same worker's record. So if your ex has remarried a couple of times, all 3 ex-wives can claim the benefits as long as the marriage has lasted at least 10 years. And the benefits paid to one don't affect those paid to the worker, the current spouse, or the other ex-spouses. And the worker will not be notified if you've applied for benefits, so you don't need to worry about them finding out that you applied based on their record. You don't need to know their whereabouts. You just need to have enough identifying information for Social Security to look up the records. You probably need to provide documentation such as your marriage and divorce information. If you're receiving divorced spouse benefits and you remarry, your divorced spouse benefits stop. However, you may then be eligible for spousal benefits based on your new husband's work record, or you could switch to your own benefit if you qualify for Social Security. Okay. Survivor benefits. Survivor benefits can also be somewhat complicated, but it's really important to understand how they work, especially when you're married, because, again, the decisions you make now can influence the amount that your survivor receives later on. And there are 2 factors that influence the amount of the survivor benefit. The first is the age at which the deceased spouse originally claimed his retirement benefit. If he applied originally before full retirement age, the survivor benefit is limited to his actual benefit or 82.5% of his primary insurance amount, whichever is higher. If he applied at his full retirement age, the survivor benefit equals 100% of his primary insurance amount. If he applied at 70, the survivor amount will include the delayed credits, and we'll have an example in a minute. The second factor is the age at which the widow claims the survivor benefit. If she claims it at 60 or 50 if disabled, the survivor benefit will equal 71.5% of the original benefit amount. If she claims it at her full retirement age or later, her survivor benefit will equal 100% of the original amount. And, of course, she could apply any time between the ages of 60 and 70, and the reduction will be prorated. Okay. We can go on to the next. Let's see. Here we go. Great. If both spouses are receiving benefits and one spouse dies, the other spouse switches to the higher benefit. So this is why it's sometimes very beneficial to wait to 70 if you can, because the higher benefit is the one that you keep. So in this hypothetical example, the couple's married, both are over for full retirement age, receiving Social Security. Joe's benefit is $2,000, Julie's is $1,200. If Joe dies, Julie's benefit stops and she gets $2,000. But the only thing here, too, is there is a loss of one benefit for survivor planning. It's projected that most people need at least 2/3 of the amount of income they were receiving as a couple. So it is important to plan for the loss of one spouse's Social Security benefit, even though it's the higher amount that will be retained. Okay, next slide. So here's an example of what happens if you claim early and how it's reduced. So in the same situation, they're married. His primary insurance amount is $2,000. He files for benefits at 62, so he's getting 75% of the $2,000 or $1,500. If he dies, Julie's going to get 82.5% or $1,650. Normally, the survivor benefit would equal the amount that the deceased spouse is receiving, but the government, I guess, has a special rule so that they get a little bit more. So Julie will just get the $1,650 only if she files for the survivor benefit at her full retirement age or later. So again, it's when he applies and when she applies. If she files as early as 60, it's going to get reduced again to $1,430. So that's why it's really important to really think about when you want to file for your benefits. So let's take a look at an example of what happens with delayed claiming. So let's say that Joe had started his Social Security at 70. His benefit is 132%, or $26.40. Now if he dies, Julie's survivor benefit is equal to that amount. If she claims her survivor benefit at 60, it'll be 71.5%, or $18.87. If she claims it at 66 or later, it'll be 100% of the full amount. Okay, more rules for survivor benefits, but these are very, very important. In order for a surviving spouse to receive the survivor benefits, the marriage must have lasted at least 9 months, except in the case of an accident. The survivor must be at least 60 or 50 if disabled. If the widow or widower applies before full retirement age, the benefit will be reduced, as you saw in the previous slides, as it is for regular retirement benefits. And some of the same principles that go into deciding when to apply for regular retirement benefits also apply to survivor benefits. If you remarry before age 60, you'll not be able to receive a survivor benefit based on your previous spouse's earnings record unless your remarriage ends. And of course, divorced spouse survivor benefits are available if the marriage lasted at least 10 years. So let's see. So that's the big question. When should we apply for benefits, or when should I apply for benefits? So the decision to apply, as I was kind of discussing early, is very, very important, obviously, and very complicated. And it can make the difference of thousands of dollars over your lifetime when you take into adjustment delayed credits, cost of living adjustments, and the like. But it's also very dependent on other things going on in your life. For example, if you're in poor health, if for some reason you have a shorter life expectancy, maybe you're not married, maybe you need income, and maybe you can't work you can't work anymore, that would be possibly reasons to take it early. But what if you have a survivor need and you can't afford to continue working? Then it's a good reason to delay it as long as you can. Okay. Again, here we're just discussing the benefits of waiting. So if you take a look at this chart, you see that the advantage of delaying benefits is that your monthly benefit will be higher. So somebody born in 1953 who had maximum earnings would get $20.14 if he applied at 62, but he gets $35.44 if he waits till age 70. The difference becomes more dramatic if we multiply by the 2.7 cost of living adjustment and the delayed credits. You can see his benefit jumps all the way up to $43.86 on this chart.
Is there a maximum amount per month people can get?
You know, I believe that there probably is, because basically I think once you calculate out, and of course obviously once you hit 70 you start collecting, because there's no more delayed credits after that. There'd be no reason not to collect. But yes, because when you look at Social Security, if you've paid in the maximum amount, then you get a certain amount. You can't get more. Does that make sense? So yes, I think
so as long as you had one of your examples is the person hit the full day maximum Social Security wage every year that they worked, and I think that's the key, is that if you're at that, that's the maximum you're ever going to get. So if they
absolutely,
that's what it's going to be. So.
Yep, absolutely. It'd be nice if we could get more, but I don't think it's. Yeah, no, that's exactly right. They take the maximum that you can, earn to qualify, and then they calculate it that way. So yeah.
Okay.
Right. So again, it's hard to pass up thinking about getting those checks when you're 62. But if you're going to live a long time and you're married, and chances are one of you is going to live a long time, you obviously can get quite a bit more if you wait. Okay. Next slide. Okay. So what are the key points to remember for when to apply for Social Security? Okay. If you apply early, your benefits start out at some fraction of your primary insurance amount, 75 or 80% or whatever, and remains at that percentage for the rest of your life. It does not go up to 100% when you reach full retirement age. The cost of living adjustments magnify the impact of earlier delayed retirement, because the annual cost of living adjustment is applied to either the lower or higher amount, and this causes the disparity to increase with each passing year. In other words, it's going on a lower amount if it's at 75% of your primary insurance amount at 62, or the higher amount if later. And also, this question impacts survivor benefits. If a higher earner's husband or wife is encouraged to delay benefits to 70, because that means their spouse will get the highest benefit after they die. Okay. So how can you maximize your benefits? So we're going to discuss 5 different strategies on how you can do this. And this is the first one that we sort of discussed a little bit, Monica, is to improve your earnings record. The first thing you can do is improve your earnings record. If you want to check your annual statement to make sure your earnings record is accurate. Mistakes are rare because the earnings are kept on file at Social Security, were reported by employers. But mistakes can happen, and if you're self-employed, that can be because the earnings are taken from tax returns.
I just came across one that was wrong with a client.
Oh.
Wow. The doctor and his son have some, Dr. Joe Smith, and his son is Joe Smith Jr., and there were a couple of years that their payroll company confused whose Social Security number they put wages on. And it was not caught on their prior accountants that did the tax return.
Wow. And that could be substantial for Joe Sr., because I'm guessing Joe Jr. was the one that got the bigger amount.
It was Joe Sr. that cut the amount because I told him, you should go back and look at your Social Security. You want to be within 5 to 7 years of retiring. You need to go look at that. Went on and said, there is something really wrong.
Yeah. Oh, no. That's right. That's right.
It can happen.
Yep. Very true. And so you can, check out your Social Security record. If you have some zeros, is there anything you can do about that? That might influence you to keep contributing to the system for a few more years to take those zeros off of your record. And then also, let's see, very good. So the second strategy is applying at the optimal time for Social Security. Now, we've been making a case for delaying benefits because that results in the highest lifetime benefit, but there's no one-size-fits-all answer to this question because there's a lot of personal issues involved as well. But the thing is to apply at the time that's optimal for you. Okay, so this next slide is going to talk a little bit about what we were discussing earlier, Monica, the annual earnings test. So basically, if you apply at 62, $1 in benefits is withheld for every 2 you earn over $15,720. And then to your point, if you're attaining your full retirement age but you're not quite there, they don't withhold as much. They withhold $1 for every $3 of what you earn over $41,880.
So if you're going to turn full retirement age in October, November, December, you've got to be really careful because they will reduce your benefits because you have worked most of the year. So it comes down to, is it better to wait until the year after your full retirement age? Then they're not going to reduce it at all. It's the year that you turn the full retirement age.
Exactly. So those folks that are born in that period of time between 55 and 59, it's going to be I'm sure they're all going to be saying, okay, when do I go apply? I attain my age 66 and then how many months later? It could get really confusing, and it's important because, again, it does affect other things later on. Mm-hmm. So it's going to be interesting when we get to that point to see,
Well, and just being the tax person that I am, if you wait till 70 to take your Social Security, at 70 and a half, you have to take your RMDs out of your other retirement plans.
Right.
So you need to work with your tax advisor because now you've got 2 big hits coming at you at the same time.
Absolutely. That's right.
More
That's right.
Take, which is your RMD, required distributions out of your other retirement plans will have an impact of how much of your Social Security is going to be taxable. So you really need to do some planning when all of a sudden this comes hitting all at the same time.
Yeah, and sometimes I think people are surprised that we'll advise them, why don't you take a little bit out of your IRA this year? You have a little room in your tax bracket, and let's move it out this year instead of waiting until you get really hit. If they can afford to do it. It depends on where they're at, obviously. It's unique to everybody, but I'm sure you've had those discussions too.
Indeed.
Okay, so now we're going to move on to the next slide, and we are going to discuss coordinating spousal benefits. So the idea here is you can maximize the income while you're both alive and for the survivor after one of you dies. It can get complicated, but by understanding considerations and doing some calculations, it is possible to come up with the right solution for your needs. So the first thing we're going to discuss is what's called file and suspend. Now, this strategy came out of the Center for Retirement Research at Boston College, and it's also called claim and suspend. So, as we talked about earlier, in order for a low-earning spouse to receive a spousal benefit, the high-earning spouse must have filed for benefits. But often, a high-earning spouse wants to delay his benefit to 70 so he can maximize his income to the couple while both are alive and income to the surviving spouse after one spouse dies. So as soon as the higher earning spouse turns full retirement age, he files for his benefit and then immediately suspends it. And this allows his wife to start her spousal benefit while his benefit earns 8% delayed credits. So in this example above, the couple is 66. His primary insurance amount is $2,000. Hers is $800, which is less than her spousal benefit of $1,000. If he waits to age 70, then she'd have to wait 4 years to get her spousal benefit. But he can file and suspend at 66, and this entitles her to the spousal benefit while his own benefit continues to earn delayed credits. Now, the key factor in all these strategies is it does not work if he's under full retirement age. It's only after full retirement age that a person may voluntarily suspend their benefit in order to earn delayed credits. Now, the low-earning spouse can, of course, apply for her spousal benefit anytime after the age of 62. If she applies before full retirement age, she gets a lower amount.
So let's go over this really slowly, because these are the important words.
Right.
And these are the important things, because this is where people get tripped up in the website.
Yep.
Because they'll allow you to start taking benefits and say, oh, when would you like to have spousal benefits for your spouse? And everyone thinks that's the same thing. It is not the same thing as what we're talking about here.
Exactly. That's right.
So
that's right.
File and suspend means sign up, but say, I don't want to take them now. I want to suspend my benefits. These are really important words, but it allows your wife then, your full retirement age, it allows your spouse to go in and claim on your account. There's no reduction of your account balance, but it's one of these quirks in Social Security that your spouse can start taking against you and not affect your benefits, and you get an 8% per year flat increase until you turn 70. So
that's right.
Nothing is happening on your spouse's account. It's not affecting her account. It's not affecting your account. It's free money.
Absolutely. And I would actually really encourage people to make an appointment if they're going to implement one of these strategies and go into the Social Security office, just so you don't have a situation where you're very confused on the website. Because I've looked at the website too, and it's really not very consumer-friendly to read. So I would highly recommend, that you make an appointment, go in, and ask a lot of questions and have this, understand what you're asking them to do. You're saying, I want to file, but I'm suspending. I'm filing, but I'm suspending. And then your wife goes in at her full retirement age, or she can go younger. She's just going to get a reduced benefit and applies on your as a spousal benefit. But, yeah,
and
very true.
We should mention, you don't have to wait until you're 70.
No,
so you get an 8% increase, flat 8% increase every year. So you could be full retirement age at 66 and just want to do it for 1 year. You're going to get an 8% increase. You could do it for 2 years. So you don't have to go from full retirement age 66 or whatever it might be to wait to 70. You can do it anywhere in between there. It's just that you get at 70, it stops. There's no more 8% increase. So
That's
you
right.
don't want to go past 70 because there's no benefit of doing that. But certainly it can be any year between full retirement and 70, and you get that 8% flat increase every year.
That's right. That's right. Okay, so next slide. This is another strategy, and this is a very interesting one as well. This one's called Claim Now, Claim More Later. And again, it came out from the Center for Retirement Research at Boston College. And this is a situation where both spouses have a pretty good Social Security earnings record. So what happens is at full retirement age, the higher earning spouse applies for his spousal benefit only. His spouse has to have filed for benefits on her own record for him to do that. And then when he turns 70, he files for his own benefit, which would include the delayed credits. So let's say this couple on the slide are 66. His primary insurance amount is $2,000. Hers is $800. She files for her benefit. Again, that's the key. At 66, and then he files for the spousal benefit and begins collecting $400. And then when he turns 70, he switches to his higher benefit, and then he gets that extra $400 per month from age 66 to age 70. And again, here, Monica, you're absolutely right. It's very important to follow the rules carefully because you can't do it before full retirement age. If you try to collect Social Security before 66, they will always give you the higher benefit, so they'll end up giving him his benefit, and they'll reduce it for early claiming. It's only after full retirement age that he can restrict, again, there's another word, restrict his application to a spousal benefit, and that's the language you use. So Social Security is just accustomed to giving people the highest benefit they're entitled to. So they would probably say, why are you doing that? You're only going to get $400 a month. But if he says, I'm restricting my application to my spousal benefit, his own higher benefit will not be part of the application. That way it can earn the delayed credits.
So it's
Another important,
this is where the higher income person wants to, because it's more, they're getting a better benefit of waiting the 8% until they turn 70. So they're going to take the lower amount of spousal on the lower spouse's income because there's going to be that bigger increase on his. And then Mary, in this scenario, he gets to 70, she gets one half of his original amount, which is $1,000 rather than her $800. So she bumps up to $200 extra a month. When he starts taking at 70, and she can then become a spousal on him. So it really is, again, a very interesting one. Very complicated. It's called claim now, claim more later. Again, keywords, restrict. I want to restrict my benefit to my lower earning spouse's spouse benefit.
And I think a really important thing to realize, and this really trips people up, is you cannot be a spousal on each person at the same time, because one person has to file and collect their benefit or suspend it, and the other collects off of them. Does that make sense? So you can't be both doing the spousal at the same time, which would be nice in some situations, but it's not possible to do that. And
so one's got to be taking their benefit as it is, and the other one's spousal, but not yet.
Yes, they're taking their benefit, or they've suspended it until later. So that's how it works. You cannot do this at the same time, unfortunately, but. And again, it's going to vary on the age and the primary insurance amounts of the respective spouses. We actually have a special spousal planning calculator. It's really hard to determine what's going to be the best strategy for everybody's individual situation. Okay, so now we're going to move on to strategy number 4, and we're going to talk a little bit about taxation. I know, Monica, you wanted to speak a little bit to this.
Well, death and taxes, so here comes the tax part. So, yeah, indeed, depending on your situation. So, and I've had people call me on this. If you only have Social Security, and heaven forbid, but if you only have Social Security and that's it, you don't have any investments, you don't have interest dividends, you have nothing else, you do not file a tax return. There is nothing to file. Social Security only becomes taxable based upon your other type of income. So what we look at is, yes, there's certain thresholds where none of your Social Security is taxable. So, again, we look at half of your Social Security plus all the rest of your income. Okay, so we always take half of your Social Security plus the rest of your income. And as you can see here, if you're married and it's under $32,000, nothing is going to be taxable for your Social Security. But then the government gets their fair share. We all kind of understood that maybe 50% of our Social Security might be taxable because 50% the employer puts in, 50% the employee contributes. How they ever got to 85%, we have still not ever understood. So, but this is it. So if you're married joint, $32,000 to $44,000 of which is half your Social Security plus everything else, if it falls in there, only 50% of your Social Security is taxable. Once half of your Social Security and everything else goes over $44,000, you're at 85%. And it stays there. It doesn't go any higher than that, but it's 85% of your Social Security is taxable. So there can be a situation when you're under 70 years of age and you haven't started taking your distributions from any retirement plans nor your Social Security that you could be in these lower tax brackets, and all of a sudden, surprise, you're going to have a big tax bill. And so you want to certainly do some tax planning with that. And then you can see single, had a household, and married separately. Married separately is the penalty box. You've heard about it. If you go in the winter and you go to Chicago, they've got a penalty box on the tar mat. Well, this is the same thing in tax. Married filing separately, anything over $1, you're at 85% of your Social Security being taxable. Okay, there's just a lot of bad things around married filing separately. But you can see here there is some tax planning as you get to those points that we talked about.
Right, there is. So if we go to the next slide, we can talk about some of this tax planning.
Kate had mentioned, depending on how your financial advisor thinks about this and how you think about it, tax-exempt income is always really good, except in the calculation of how much of your Social Security is going to be taxable. So when we determine how much of your Social Security is taxable, your tax-exempt income goes right in there. So it may not be income taxable, but it does affect how much of your Social Security is taxable. And again, we might want you to take out some of your retirement plan money before you take your Social Security. It brings down the balances in some of your accounts, so their RMDs would be based on a lower amount because your required minimum distributions are based upon the value of your accounts. So there is some tax planning between 66 and 70 where we might be pulling from the retirement plans to bring those balances down so that the hit isn't so bad when you hit 70. Roth plans are great. I'm just going to leave it as complicated.
Yep.
The closer you get to retirement, the worst decision you could potentially make, unless you can let those Roths sit out there for 10 to 15 years plus. But it really takes someone that knows all of your financial investments to give you that advice as you're getting closer to retirement. But, regardless of this and taxes, what you want is to feel comfortable in retirement that you have enough money to live on. It means really understanding your budget when you're retired. I have many of my clients that don't think about the things that the business is paying that now are going to come home, and you have to pay them from your home budget. And it's really important when we sit and we do budgets, and Kate does this too, that you understand those costs you haven't been paying for 30 years are now going to be paid out of your retirement money. Also, we tend to spend more in the early years of retirement than we do in the later years of retirement, and that gets factored in, and I know Kate and Ted do that as well.
Yeah, very true, and all good points. So let's see if we move on to the next slide. Basically what you're just talked about, Monica, you want to coordinate your Social Security with your overall retirement income plan and also your retirement spending plan. So it's really important to understand that Social Security personnel, what they can and can't do. They can help you estimate your benefits. They can tell you what you're entitled to, but they cannot project future benefits through the scenario planning that we've been talking about. And they're not going to be very helpful with the file and suspend, claim more, claim now, claim more later. So we have, as I mentioned before, we have calculators so we can help you project your Social Security using these different scenarios if you can give us your Social Security record statement. So if we go to the next slide, this is pretty much, we all know the answer to this question. Social Security be enough to live on retirement? Probably not. Okay.
So you had mentioned that Social Security is about 40 to 50%?
Yes, depending on, I think on average it's 40%. I would say for a lot of people it's probably higher, but that's the context, yes, 40%.
Wow, okay.
Yeah, that is kind of scary in a way.
It's going to be scary for a lot of people hearing this.
Okay, so again, you want to consider Social Security in the context of your other retirement resources, your pensions, IRAs, 401ks, your retirement distribution, and you want to coordinate all of this so that you can have the income that you need for the rest of your life. Retirement planning is a little bit easier when it's just a matter of stashing part of your salary, as long as you're saving enough that when you retire, you're going to have a good nest egg. But when comes time to convert it into a retirement income stream, that's where it gets a little trickier. As Monica said, really anticipating what your expenses are going to be. Are there things that you were paying through your business, now you're going to pay personally? Are there things generally, we want to travel more in the beginning, we want to fix up the house, all those kind of things can be obviously a big part of it. But as you can see, because you can't outlive Social Security, it can be a real good foundation of your retirement income plan as long as you coordinate it with your other resources.
And I think we're talking about Social Security here and how to maximize your Social Security. I think we should be really clear, though, Kate, is that we're not trying to say live on Social Security in retirement, and we're not even trying to say go to the maximum Social Security wages every year. Because the reality is we don't want you to live on Social Security. We don't want you to live on it. We want you to live on having a very solid retirement plan with your investments, your business, various things coming into your plan. We're not at all trying to say this is it. This is your bucket of money, is Social Security, and make sure you get the maximum. We want you to get the maximum, but by no means are we trying to say live on just your Social Security. In fact, for some people, we say that's your travel money.
Right. Good point. Very good point. Because of the fact that when you look at it, even though, the numbers even inflated look big, but everything is going up every year. So a number now that's, years ago, $1 million was a lot of money. Now it's not that it's not a lot of money, but it's everything else is going up at the same time. So you're absolutely right. The idea with this is, I think, for people to understand what their options are so they can make the smartest decision for themselves. And that's what we wanted to do with this presentation. So if we go to the next slide, you probably do have a lot of questions. Again, when should you apply? What if you want to keep working? Have you already applied? What are your benefits going to be? Can you coordinate? And what's the long-term strategy? And as a firm at Gregory Advisors, we work with our clients each individually on all of these things because everybody's situation is unique and different. So we, as part of our wealth planning and financial planning process, we definitely will look at a client's entire situation, and that includes Social Security and what kind of planning should they be doing around that.
Now, for my clients, because they're listening to you on this, would they be able to contact you and maybe just contract with you guys at this point to help them understand how to maximize their Social Security benefits and what might be best in their situation?
Absolutely. Absolutely. Please feel free. I believe there's a slide with my contact information. You can reach out to me at the phone number there, 714-372-2299, or my email address, kate@gregoryadvisorsinc.com, and be happy to speak with them and discuss a little bit about what we do. We will generally talk with somebody on the phone, and if it looks like, we can be of help, we'll meet with them. We don't have any sort of fee for the first meeting because we like to see if we're going to be able to be of assistance. The other thing is on our website, we have a couple of we've just revamped it, and we actually have a retirement income or a retirement planning kit that can be downloaded. It's a PDF, and it has a checklist of a ton of items that need to be done before you retire. So I would encourage people to take advantage of that as well. So
fantastic.
Yeah.
Well, so should we see if we've got some live questions, Jeff?
Sure. Thanks, Monica. I've opened up the phone line, so again, if you're listening live, just go ahead and talk and ask your questions. I am checking on the Internet. I do not see any questions that have come through during the presentation. So I don't hear any on the phone, so I think, Kate, you answered every question up front. It's a new world record. It's a lot of information to go through.
It is. That's why I would encourage anybody to give us a call. Especially the spousal strategies. It takes a lot to wrap your head around them because it's different than anything we've heard, and there's a lot of factors that are involved. So absolutely, yeah.
I agree. I think the spousal aspect, how do I maximize it, these words that we're using, people have to hear it over and over and really understand the various calculations over and over because never heard about it before. You sign up, you get your Social Security, your spouse gets their Social Security based upon their wages that they've had their life. What is this new thing? Explain that again. So it's very complicated, and really you have to be walked through it a few times. Definitely do. Well, very good. Well, this has been very good. Kate, we really appreciate you taking your evening and doing this for us because I knew that you guys were specializing in this and you could add a lot more than what I have provided in the past. So, and a new resource. And I think that everyone that's hearing this should reach out to you guys and have you help them with their planning. Because again, yes, we want to get the most out of Social Security we can, but more importantly, it's just part of it. That's right. And I never want to see people saying, well, I'm going to raise my salary so I can get the most out of Social Security. Well, let's think about that. So, overall, we want you to have wealth. It's just not, always in one basket. So very true, and good point. Well, thank you for asking me to participate. I really appreciate it. And again, anybody, if you have any further questions and you want to review some of this that I've gone over or questions specific to your situation, feel free to reach out to me. I'd be happy to talk to you.
Great. Kate and Monica, thank you very much. Again, we want to thank everybody else that was on the call live today and listening on the replay with Monica Rebella. This call was titled Maximizing Your Social Security Benefits with Kate Gregory. Thanks again, everybody, and we'll talk to you soon.
Bye. Bye.